thank you to everybody for being with us today. I will invite Ted Jadick, who is the head of DNB Capital Markets, to kick off the conference and thank him for his partnership and for the bank's support and involvement with this event.
I want to wish everybody a special welcome to the conference, particularly those of you who have traveled to be here. For the second year in a row, DNB Markets Inc. is partnering with Capital Link to sponsor this annual New York Maritime Forum. Ninth year in a row. We're very pleased and excited to be working with Nicolas and your team again this year. I can't start my comments without noting the tragic events in Las Vegas last night. Our thoughts and prayers are with all those affected by this horror. We're coming into the home stretch of 2017. I think the overall picture of the market from a shipping perspective is brightening, and the prospects for a better market ahead are healthy. The world economy is reasonably robust and balanced. Demand side of the equation is solid, and the supply picture is improving substantially. The dearth of new building ordering over the past 2 years leaves the delivery schedule over the next several years, 2018 and 19, at very low levels. And most, if not everyone in the room, understands what this will mean. Some sectors will need a little bit more time and will need to be a bit more patient than others. Probably for the tanker guys, we may be coming to the winter of our discontent. But even for them, clearer skies, I believe, will be here soon. At the same time, we have a stock market here in the U.S. at or close to historical high level. Interest rate environment remains benign. Bond markets booming. Yields in both investment grade and high yield markets at or near historical lows. The unwinding of the Fed's balance sheet beginning this month, but as it's formulated at this stage, it appears to be a long, drawn-out affair. Inflation remains well below targeted levels, both here and in Europe. And U.S. interest rate future price, the future market indicates that the market does not buy into the Fed's current dot plot. Crude oil prices look to have begun a sustained uptick as OPEC production cuts hold and global demand for the commodity continues to grow at a healthy clip. Inventory reductions have now occurred for 30-plus weeks, and the directional uncertainty of a few months ago is no longer with us. Commodity markets, emerging markets, in good shape, M&A activity, robust. Political and geopolitical uncertainty, and there are many aspects here in virtually every region on the globe, is probably the main negative factor potentially affecting global economic activity. But so far, aside from the odd bad day, now and again, this has not deterred the strong performance of global markets. The VIX index remains at historically low levels. I found it very interesting to read numerous articles from the recent Frankfurt Auto Show, particularly regarding the express commitment of a number of the major car manufacturers to quicken the pace of their investments in electric propulsion and self-driving vehicles and establish firm timelines for phasing out the production of traditional combustion engine-powered vehicles. In addition, a number of countries, including some big ones like China, England, France, are also moving towards establishing fixed dates by which traditionally powered vehicles will no longer be permitted. This is a development which will obviously be a game changer for shipping, for everything really. Talk about uncertainty. But that's a discussion for another day and further down the road. In the near to medium term, the market-specific factors we are all working with in shipping point to a better physical market and a higher level of activity, driven by, first, countercyclical investment. Values in most, if not all, of the major shipping sectors are at or close to historical lows. And I believe that companies who want to create sustainable value and competitive advantage in the medium to long term cannot miss this opportunity. Second, new investment will be funded in large measure by new equity raised from investors seeing the medium-term value play. Owners increasingly understand that the leverage in the shipping business needs to be more moderate than it has been historically. And in parallel with that, you have the fact that traditional debt financing continues to be a scarce resource. This is a structural factor, not a cyclical one. It's not going away. And third, increased M&A activity will be part of the picture. as many private equity owners will need to use this market window to to monetize, not necessarily exit, but to monetize their positions, and long-term institutional shareholders demand greater liquidity in the shares of the companies they choose to invest in. Demand for liquidity will increasingly challenge the market for initial public offerings as well. The vast majority of private companies are too small to be interesting to long-term institutional investors. M&A will need to come into play if you want to be public. Get bigger or merge. There are always opportunities in shipping, and the current market is certainly no exception. But enough of my prognostications. We've put together today what we think is a great lineup of companies representing all of or most of the major shipping sectors to give you their views on where we are and what's ahead. We also have panels of experts on the insurance and legal side, as well as presentations on relevant issues from local government entities responsible for maritime, port, and logistics activities in the New York area. So let's get started. Thank you again, everyone, for being with us here today. And on behalf of DNB Markets and Capital Link, we very much hope you will find this to be a day well spent.